Hello, welcome back again. Now, in this video, we're going to be talking about the subscriber request, Tencent Music Entertainment Group, a company that is from China, and it has a stock beta of 1.13, meaning that it's about 13% more volatile than the overall market, so it moves a little bit more. And in IPO of 2018, this company operates a platform, a music entertainment platform, and provides streaming, karaoke, and other live streaming services in the People's Republic of China. Let's take a look at what the company is doing financially and what the chart will display to us, will show us. Now, you will see that the company's stock price has been completely annihilated. It's down 80% almost. And even though in the pre-market is up 2.2% today with the overall Chinese market, pretty much many Chinese companies, if not all of them right now, they're going to be opening up higher. What's going on here is that the company's stock price has been going down and down. Even if we take a look at the max chart, you will kind of see we're below the IPO dates, And in the last year, look at this downtrend. This is amazing, going down and down and down and down. Now, we're always saying that it's not a good idea to catch a falling knife, but it's a very good idea to catch a company that's doing very well when it's underpriced. So this is what we're going to be examining here, because we may be able to buy a gem and just hold it for a few years or so, see how it will do in the future. Because if it's overpriced, it's my thing. If it's underpriced, it's my thing. So let's take a look at the financials here. The PE ratio of the company is at 14.6, and you will notice that it has been down massively from its previous highs. And this is when I wouldn't buy, more than likely. This was 140 for 40 here. Even here it was a little bit elevated, but now it's going down and dropping to 14.6 as the stock price drops. And the price to free cash flow ratio, again, similarly going down very nicely with the PE ratio. The company's outstanding shares is also 10% higher, which is not a good thing to see, because it means that the company has been diluting investors. 10% is not horrible, but it's rather significant, so I'd rather not have them do that. I am assuming they were taking advantage of the stock price, so that makes sense. But as it's going down, more than likely I would think that they would potentially think of actually buying back shares and not keep issuing. It doesn't make a lot of sense to issue shares right now. And the free cash flow to total liabilities ratio is sitting at 3, meaning that the company requires about 3 years of its last year's free cash flow to pay back all the total liabilities that it has. More on this thing a little bit later when we examine the financial statements. The 5-year revenue growth has been pretty nice over here, steady and nice. The same thing with the income growth, the net income growth, a little bit down in 2021, but that's no big deal. It happens with companies that not all companies will be having skyrocketing revenues and net incomes every year, and even if it goes down a year, it's not a huge deal as long as the overall pattern is increasing. The free cash flow growth is doing pretty well as well, yes, although a little bit stagnant in the last couple or 3 years. That's okay. The 5-year total equity growth also growing for the company. Remember, they did issue shares, so they did get some equity from the shares. Okay, so the debt to equity ratio is rather low here, very nice to see. And current ratio pretty good as well, meaning that the company has quite a few current assets when you compare it to its current liabilities. Not great returns here in terms of equity and capital employed. They could do better with this for sure. The company is not paying a dividend here. And let's take a look at what is going on with their financial statements here. Okay, so the revenue of the company has been increasing 1.6 to 4.9 here. Very interesting. And this is a significant increase, actually. It's about almost 3 times as much. Great thing to see for the company. Growing their gross profit as well with that. And if we go down, when we examine the net income, you will see that the company's net income has been increasing, although in the last year it has been going down from its previous year, so there's a little bit of a slump. But overall, you are looking at a company that has been increasing its net income, not tremendously though, and less than what they have been doing with the revenues. Although still there has been an increase. And, we have to factor the current price of the stock as well, eventually. We will do that later in our stock evaluation tool. Now, we can see that the total assets of the company have also been increasing. Again, a little bit of a slump in the last year, no big deal. Liabilities increasing with the assets, very, very normal. But overall, the total equity has doubled in the last 4 or 5 years, pretty much. That's another great thing to see. Okay, and if we take a look at the cash flow statement, you will see here that the net cash provided by operating activities has been increasing pretty well, although again a little bit stagnant in the past like 4 years or so. And I don't see metrics that make sense for the insane drop though so far. So the net income here is actually producing this kind of cash flow, 823 million for operating activities of the company. In terms of investing activities, the company has been investing a little bit, and that's good to see. Financing activities, pretty much, paying back some debt here, nice to see as well. They got some debt back in 2020 over here. And the cash flow is what matters, 372 million to 823. Another pretty nice increase in terms of their free cash flow growth here. Company is doing pretty well, it looks like, and they are increasing their cash reserves as well. Now, let's take a look at our stock evaluation tool and see what kind of price it makes sense to pay for this baby. So, let's see here. The revenue has been increasing, although in the last year, 2021, the increase was 7%. So it looks like as if they're having declining revenues here. It's going down. And so we will have to be conservative. We'll go 5, 7, and 9 here and see what we'll get out of this, because we are seeing decreasing revenues here. So we need to factor that in our projections. Now remember, these are 5-year projections. If they were 10-year projections, maybe I would go even lower. Maybe I would go like 2, 3, and 4 potentially, or 3, 4, and 5, something of that sort, because there is more risk when you are looking ahead for more years. So the net income margin, very nicely sitting at similar ranges here. I'd like to see that. So we're going 9, 11, and 13, pretty much using all the ranges. Free cash flow margin, we're going to go, these are very high free cash flow margins here. I'm going to go 105, 110, and 115. And an annual return of 13% is what I typically want to be making out of any single stock, because I can buy an S&P 500 ETF, and these tend to make about 10% a year. So I have more risk by buying a single stock, and this is why I need a better return. Let's hit calculate. And when we do that, we see that the company definitely looks like a buy right now, because even at our lower estimates here, 4.52 is actually higher than our current price, which is sitting at 4. And so the medium, I think, is probably the one that makes the most sense to me. I think this kind of projections here probably make the most sense based on what I'm seeing for the company. I'm definitely willing to go with those. And these actually point to a company that I could easily buy today for $6.3. This is a massive increase from its actual price, which is $4.05 pretty much. And so for me, this company is a buy right now. It looks undervalued, and it looks like a potentially interesting hold. And I'm assuming that this will be one of the companies that will likely boom if the issue with China gets resolved, because again, this looks undervalued compared to the financials of the company, which are looking pretty nice over here. So yeah, I myself would definitely look into getting a little bit of this one. Thank you for watching. I hope you enjoyed the video and it helped you a little bit. Thank you for the suggestion. And if you are not a subscriber, remember to become one, and also like the video. That helps a lot. And I'll see you in the very next one. Bye bye.